ahead and start. Thank you. So we'll go ahead and kick us off. Welcome, everyone. My name is Marie Grant. I'm Maryland's Insurance Commissioner. This is the Private Passenger Auto Insurance Affordability Workgroup, created by House Bill 1098 of the 2025 session. Thank you to our workgroup members for joining us and your participation today. We have a pretty meaty agenda, lots of information, and hoping to get some feedback and discussion going. So can we go ahead and go to the next slide? So our topics for presentation and discussion today, I'm going to give an overview of some ways that affordability is handled or could be considered in establishing private passenger auto insurance rates consistent with rate-making principles in the insurance article. And so we're going to look at some Maryland's own law and history, as well as NEIC recommendations and some of the interesting things going on in other states. We're going to hear from former Commissioner Al Redmer from the Maryland Automobile Insurance Fund to talk about the Maryland Auto Affordability Index and the use of that index by Maryland Auto. We're going to hear from Marceline White from Economic Action Maryland, another one of our work group members, to talk about auto affordability in Maryland methodologies and options for consideration. We're going to have some work group discussion. And then if time permits, and hopefully time will permit, we'll take questions and comments from the public. And I believe at the appropriate time, how we'll handle that is if you're an attendee, use the raise hand feature, and then we'll be able to move you over to the panel side and ask your questions. Welcome, Senator Guile. We were just doing housekeeping and going over our agenda. Welcome. Okay, any other questions before we get started? Okay, can we go to the next slide, Craig? Okay. So I'm about to run through a lot of information. There's I'll try not to just read everything on the slides. We're going to talk a little bit about recent rate trends in Maryland that we've seen in the private passenger auto market as a whole. We're going to talk about some of the transparency and readability of consumer information. We're going to talk about rate regulation, different types of rate filing regulatory systems, what we have in Maryland versus what's happening in other states. We'll talk a little bit about non-driving rating factors. And then we're going to talk about a couple of examples of state-sponsored no-cost and low-cost auto insurance programs. Next slide. And Craig, did you get Jamie's message? I think Delegate David Fraser Hidalgo is one of the phone numbers on the call. Okay. So just as a follow-up to our discussion at our last work group meeting, our recent rate filings indicate that premium rate increases in private passenger auto are leveling off in Maryland. We've seen inflationary pressures somewhat cooling, and we've seen projected increases in insurers' costs and expenses have improved. So between January 1st and September 4th of this year, we only saw 4 of our top 10 carriers file any rate change. And we're going to talk through on the next slide sort of the range of increases we've been seeing year over year and why we think we're leveling off. And there's a very important caveat at the bottom of the page here. While it seems that the rate of general premium increases is slowing, That doesn't necessarily mean that consumers should expect to see their premiums drop, but we aren't seeing the increases that we have in the past. Next slide. All right. So this is a busy slide, but what it essentially shows is the range of both indicated, what our auto insurers are saying that their risk or their books is showing for needed rate increases, and then what our actual proposals have been. And so if you look on the proposed slide, side of the slide, you can see the high, low, and the range. And you can see just generally that since 2020, where we saw at the high end, a very slight increase, and at the low end, a substantial decrease. We had several years of ranges of increase. And then last year, we saw a little bit of a slowing down. But this year, again, we're seeing single digit increases as our requested high. And at low, we've actually seen some reductions. So it's that is a positive and hopeful sign in what we're seeing in this market this year. Next slide. Okay. So I'm going to talk a little bit about information that we put out about rating. We have a number of consumer guides on our website that try to explain in plain language just how auto insurers are performing rating. And auto insurers generally have a general risk profile as well as individual characteristics. In Maryland, risk characteristics that an insurer can rely on to rate your policy might include your driving record, geographical area in which you live, gender, age, marital status, prior insurance coverage, your vehicle itself, the age, make, and model, and credit history on the initial writing of a policy, which we'll talk about in a little more detail. Um, so some of our insurers do review an applicant's credit history when rating a new policy. They can't do it on renewal. So you can't increase a renewal premium based on credit history. You can't apply a surcharge of more than 40% based on credit history under Maryland law, or use any of the following factors to read a policy. And that includes the absence of or inability to obtain credit history, the number of credit inquiries, or any factor that is more than 5 years old. Next slide. So if your insurer did use credit history as a factor, you have the right to request that your insurer recheck your credit history once per policy period. And if it has improved, your renewal premium can be reduced. If it's deteriorated, though, under Maryland law, this information cannot be used to increase your premium. And then if your insurer proposes to increase your premium rate, they need to send you a notice at least 45 days in advance of the effective date with the new premium rate. So when a premium increases based on the driving record of one or more, but fewer than all drivers insured under the policy, the notice must provide you with the option to exclude the driver whose record is causing the increase from the policy. So again, there's some information at the bottom, and this is just from our consumer guide about general rate increases. Next slide. Okay. So we do also publish an MIA comparison guide to automobile insurance rates for vehicles that we have information about. So we update that guide every 6 months, present scenarios, and list premium rates that licensed private insurers as well as Maryland Auto would charge consumers. The guide actually indicates which insurers use credit as a rating factor. Several private insurers, as well as Maryland Auto, do not. And we're in the process of gathering premium quotes from insurers to include in the next edition, which should be published in February of 2026. That's what we're anticipating right now. And scenarios in the next edition are going to cover some newer vehicle models. Again, right now we have a sampling, and I think our sampling has some older models right now. And we're also going to include electric vehicles in that update. Joy, I hate to put you on the spot, but I just went over a lot of information generally in your purview. Any comments you wanted to add?
No, you touched on everything, and we would just invite people. The next slide gives everyone a long list of all of the resources. And also, Craig's team does a great job on social media. So we would just invite folks to go to our website, follow us on the various social media platforms. And one thing that within the last couple of years that we have included, we have the hard copy of the rate guide, but we've also made it a little bit interactive. It's not AI, but it is a little bit more interactive. So you can, it's a little easier, I think, for those of us who want to compare rates, but do it a little bit easier.
Great, thanks, Joy. Okay, moving on. So, um, this slide presents a summary of the premium increase notice requirements that are under Maryland law today. So unless an insurer provides notice of its intention not to renew a private passenger auto policy, the insurer must notify the policy holder of the renewal premium at least 45 days before it's effective. And if the increase is due to a general or across the board rate increase, the insurer doesn't have to explain that to a policyholder. But if the increase is due to something else beyond a general increase, so if it's about a surcharge, if it's about removal or reduction of a discount, retiering or reclassification, the insurer has to provide the policyholder with an explanatory notice. It needs to be on a form approved by the MIA. It needs to state in clear and specific terms the basis for the premium increase and explain that the policyholder can protest the premium increase. And in the case of an increase of over 15%, request a hearing at the MIA. And we've issued last year a clarification that notice of premium increases based on information about an insured's driving behaviors collected through a telematics program also need to follow these standards. And we have some examples in that bulletin of things that we think demonstrate meeting those standards under current Maryland law. Next slide. Okay. So the National Association of Insurance Commissioners, and I'll probably call them NEIC here and after, has a transparency and readability of consumer information working group. And one of that working group's charges is to develop voluntary regulatory guidance relating to disclosures of premium increases for P&C insurance products. And they actually published a premium increase transparency disclosure guide for states earlier this year. And it has a couple of recommendations that aren't currently in Maryland law. So first of all, it recommends requiring that private passenger auto insurers automatically provide premium change notices with reasonable explanations for the causes of premium increases for insurance policies in advance of any premium increase, whether that be general or specific to the individual, of 10% or more. And it also recommends requiring that a premium charge notice specify the dollar impact of each major factor that led to the premium increase. And then under current Maryland law, those notices have to specify the amount of the increase attributable to a telematics program. They need to provide a specific description of other contributing factors, but the dollar impact of all those factors doesn't have to be specified in the notice that goes to consumers. Next slide. Okay. I'm going to talk a little bit about all the different forms of rate review that exist among the states. Sort of going from, I think, most restrictive to least restrictive. So most restrictive would be actually set by the state's insurance commissioner. Prior approval is the next least restrictive. Rate changes must be filed with and approved by the regulator in prior approval before they can be implemented. And that can occur by means of a deemer provision. Prior approval happens in Maryland in healthcare. There's also modified prior approval, where rate revisions involving change in expense ratio or rate relativity require prior approval. So certain types of rate filings. And then rate revisions based on experience only are subject to file and use. Going again to least restrictive, there's something called flex rating, where prior approval of rate changes is only required if they exceed a certain percentage above or sometimes below the previously filed rates. Then there is file and use. That's where we are largely in Maryland with our property and casualty rates. Rates have to be filed with us prior to them being using. Specific approval is not required, but I do just need to share, and I'm sure my insurers would run to tell. Insurers don't always like to go out and use the rate without specific approval because there is a compliance and a risk. If a regulator determines that the rates aren't, that we do have questions about the rates. And so I just file and use doesn't necessarily mean insurers are just running out and using the rate, is what I'm trying to say. We do have actuaries that look at these rates. Then there's use and file, where rates must be filed with the regulator within a specified period after they have been implemented. And then in a few instances, although I think those instances may be pretty limited at this point, no file. Rate changes don't have to be filed with or approved by the regulator. However, companies must maintain records of information used to develop the rates and then make them available to the regulator on request. Okay, next slide. Okay. So, and I will invite my colleague Van Dorsey to chime in on this slide, but this slide describes our competitive rating laws. So in 1995, Maryland changed the standard of review for private passenger auto and other lines of P&C insurance from prior approval to file and use, and resulting in what we call competitive rating in Maryland for most lines of P&C. And so what that means is that each insurer and designated rating organization must file all rates and supplementary rate information, as well as any changes on or before the day they become effective. And then our standard of review at the MIA is that we can't disapprove a filed rate as excessive unless the commissioner has determined that the rate is unreasonably high for the insurance provided and issued a ruling that a reasonable degree of competition doesn't exist in a market to which the rate is applicable. We do also look at rates for whether they are inadequate or unfairly discriminatory. So several states, this was a historical trend at the time, moved from prior approval of rates to competitive rating in the 1990s, to give more flexibility to insurers, essentially to allow insurers to react quickly to business models, by decreasing rates when claims experience is favorable and then increasing, if claims experience deteriorates. And so sort of the cited advantages of competitive rating, maintain that the market essentially really helps prevent excessive rates, and that competition encourages insurers to accept more risk, thereby making insurance more widely available. Van, how'd I do? Oh, you're on. We can't hear you. Sorry.
It's a very high bar under the statute.
Yeah. All right. Next slide. So we have seen a little bit of a trend in recent years, where regulators in several states have, increased their scrutiny of private passenger auto insurance rate filings. First of all, through existing rate processes, just asking more questions, using the tools that regulators have to their advantage. But we've also seen some changes in law. So in 2023, DC passed a law requiring prior approval of any private passenger auto insurance rate change, but that a rate filing is deemed approved if no determination is rendered within 3 months. And they went to that after file and use. Vermont recently changed their law, where they, are maintaining their existing file and use standard, but extending the number of days prior to implementation from 15 to 30 days. In Texas, there was a bill, it looks like it didn't actually pass, but it would have required prior approval of any private passenger auto insurance rate change of 5% or more. And then there is a bill, I think, under consideration in Illinois right now. I'm not sure if final determination has been, made. Illinois actually has use and file, interestingly, so there's really not a lot of authority their regulator has over auto rates. But there is legislation that would require prior approval of any private passenger, auto insurance rate change. Next slide. So, uh, uh, there really is, this is just some information from the Insurance Research Council and a study that they did in 2024 on rate regulation. And I think key findings, were that there's approximately the same number of rate filings made each year across the country, without much variance. The number of days to approve rate filings has increased by about 40%. The number of filings withdrawn increased by about 40%. It's become a lot more common for regulators to approve smaller rate increases than originally requested by insurers. And the gap between filed and approved rates has widened. In the same time, market concentration has ticked up a bit nationwide, and filing process measures and market outcomes vary by regulatory systems. So some of the commentary here, I think reasonable people could probably argue, but at least the Insurance Research Council found, that processes to achieve approved rate filings for auto insurance have become more cumbersome since 2010. And I think they found that negatively impacted market performance. And that longer rate review processes can make it more difficult for insurers to implement timely rate increases to get to rate adequacy, and that they may be pushing the industry towards a less competitive landscape. Next slide. So, generally, Maryland's auto rating restrictions align with the majority of states. So again, we can't have rates that are inadequate. We can't have rates that are excessive, and we can't have rates that are unfairly discriminatory. That is, premium rate differentials cannot be based on something other than actuarial risk. And then insurers are prohibited from collecting or using information about the race, creed, color, and national origin of applicants or insureds. There are some states that have banned the use of certain non-driving rating factors viewed as potential proxies for unfair discrimination. And so some examples here. In California, an insurer can only use factors mandated or expressly permitted by statute or regulation for auto rating. And they have to weight the relative importance of those factors as described by regulation. So you can use in California driving safety record, miles driven annually, years of driving experience. What you can't use is gender, age, credit history, education, occupation, employment status, residential status, or insurance history. In Hawaii, auto insurers can't base any rating standard or rating plan on age, gender, length of driving experience, credit bureau rating, or marital status. Next slide. Here's a few more examples. Massachusetts, Michigan, in North Carolina, rating classification can't be based on age or gender. And then in New York, they've taken an interesting approach in that an insurer can't use occupational status or educational level as rating factors unless the insurer demonstrates to the satisfaction of their insurance commissioner that the use of these factors doesn't result in rates that are unfairly discriminatory. Next slide. So that was, maybe let me pause there and see if there are work group questions or clarifications before I go into credit history. Nancy, go ahead.
Hi, I just wanted to go back to the slide 11 about the NAIC transparency.
Yeah.
I just want to make sure that it's pretty clear that this is voluntary regulatory guidance. I just don't want it to think that it's, recommendations that must be adopted by the states that have been put out by NAIC. And obviously, you've already pointed out that Maryland has done a lot to disclose premium increases already. So we're one of the states that have been ahead of the curve of what they were recommending. So that was just one thing. And it was pretty clear in the minutes that were adopted by NAIC to make sure that the document was only guidance for the states.
Yeah, absolutely. Thank you for that clarification, Nancy. Just a recommendation, not a
Thank you.
requirement.
And I just,
Okay.
I did have one other question for you. When we talk about fallen use or prior approval or whatever, there's no indication that by having either prior approval or fallen use or use and file, that rates have actually are decreased when you have a longer time to review the rates. There's no correlation between the two. Now, you did point out that we can't react as quickly when it takes longer to review rates, and that's been a concern, but that has nothing to do with the time that it takes to review rates, whether it's prior approval or file and use. It just takes that it's longer it takes to approve a rate because, as you said, that they're getting more complicated and it's taking longer. It's just that the companies have a longer time that they can react to it, implement a rate increase. So I thank you for putting that in on the slide.
Yeah, thanks, Nancy. I mean, I just want to, I'm not sure I agree with everything you just said, but maybe a lot of it. I think we have in Maryland a pretty good indication that the proposed rates that our carriers are filing are usually far less than their indicated rates, which is, I think, what the actual risk of their book is showing. I do think there is value in making sure that regulators are asking hard questions. And I think there can be appropriate consumer results, although, you know, if you have a great citation for the fact that it has no result on overall rate increases, I think that would be helpful, but,
Yeah, we
uh,
looked for something. I couldn't find it yet, but
okay.
our early point was that it doesn't, you know, having more scrutiny doesn't mean the rates are lower. So anyway,
Doesn't change the underlying risk factors. I think we
exactly.
can
Thank you.
agree there. Okay. Um, okay, great. Any other questions before I turn to credit? So just a closer look at credit history, which is a non-driving rating factor that Maryland insurers can use in limited circumstances on the initial filing. So at least 4 states from our research outright prohibit private auto insurers from using credit history and rating. That includes California, Hawaii, Massachusetts, and Michigan. And then several states, like Maryland, limit how auto insurers can engage in this practice. So, for example, in Utah, an insurer can only use credit history as the basis for a premium discount. In Oregon, if a policy was assigned a higher premium rate due to disputed credit history, the insurer needs to re-rate the policy retroactive to the effective date based on accurate credit history. And then in Connecticut, an insurer with a rating plan that uses credit history has to submit to their insurance commissioner documentation showing how the program impacts consumers in urban versus non-urban territories and of different ages. A credit-based rating score can't be impacted by collection accounts with a medical industry code. And then an insurer must grant a reasonable exception to its credit-based rating rules if an applicant's credit history is adversely impacted during the past 3 years by catastrophic illness or injury, divorce, identity theft, death of a spouse, child, or parent, involuntary unemployment of more than 3 months, or a loss rendering their home uninhabitable. Next slide. So here's a more in-depth description of how Maryland law currently limits the ways that private passenger auto insurers can use credit history. So you can't refuse to underwrite, cancel, refuse to renew, or increase a renewal premium based on credit history. Insurers cannot require a particular payment plan for a policy based on credit history. An insurer that uses credit history and rating, a new policy has to inform the applicant. They must, on request of the applicant, provide a premium quotation that separately identifies the portion of the premium attributable to credit history. There's a limit on what can happen. The discount or surcharge can't be more than 40%. A policy can't be rated on the absence of or inability to obtain credit history, the number of credit inquiries, or any credit history factor that is more than 5 years old. An insurer that used credit history to rate a policy needs to look at that every 2 years or on request by the insured and adjust the premium if the insured qualifies for a more favorable credit history rating. And then they can't ding the person if their credit has worsened in that time. So, generally, we recommend that consumers with good credit history consider insurers that use credit history as a rating factor, and consumers with poor credit history consider the several insurers that do not. Joy, do you have anything further to add to this slide?
No, I think you've hit everything.
Okay, great. Any questions from anyone on the work group before we move?
I have one.
Yeah,
I just wanted to say, wanted to know if you could speak a little bit to what Maryland does for homeowners insurance with other use of credit.
Yeah, so in homeowners, the use of credit is prohibited in rating.
And that was decided at the same time that this use of credit for auto insurance was decided. Is that correct?
That's my recollection. I think
Okay,
Marceline, you and Joy can probably speak to that better than me.
thank you.
I think there was a very large discussion about the policy around credit and sort of our law with a whole lot of caveats in auto came out of that extensive policy discussion. Nancy.
That was my understanding as well. Thanks. It was before my time. Thanks.
I think that something that to talk about nationally is that the use of credit sort of started back in 1993. And at that time, companies, when they were underwriting a risk, really kind of set it up into three buckets: good, fair, or excellent. Those are the buckets they sort of set up. With the use of credit, they were able to do a lot more precision risk segmentation, so that many of the drivers that were currently at that time written in the high risk pools were were stuck paying higher rates because they had nowhere else to go. But when they introduced credit, the number of rating tiers increased dramatically, and it allowed insurers to more accurately measure and price risk. So what happened is, from the period from like 1985 to 2023, the number of vehicles and drivers in those high risk pools really went down. And I think Maryland Auto Insurance Fund also saw a big decrease as well, although Al will talk about that it just recently went up. But we did a review of 25 states, which I can always share. I think back in 1985, there was 1.6 million drivers in high risk pools in these 25 states. In 2023, there was 190,000 drivers in the high risk pool, and that's over 25 states. So you can see that it actually has helped us to write more high risk drivers into the standard market. So I can share that document.
I'm super excited to see it, Nancy. I mean, I'm really super curious to see how credit is correlated to writing folks into that market, because it seems like it's never, we can't find a causal relationship between credit and driving, certainly. So I think that's one of the challenges. And of course, to have consumers receive a 40% surcharge for people with poor credit is always a challenge in Maryland, but I'm excited for the discussion.
Yeah, that's great. Thanks, Marceline. And I know that we are always open to discussions. We've been discussing this for years, right, Marceline?
Yep.
Thanks.
Delegate David Fraser Hurdle.
Yeah, it's more of a comment than a question. Marceline, thank you for your comments, but I can only hear like a third of what you're saying. I don't know if anybody else is having a problem, but I think you have a mic problem of some kind. Is anybody else having the same problem understanding her?
I hear muffled, but I can
Yes, that's
hear
what
the words.
Is it better if I'm closer? I apologize. I'm actually on vacation, and so I have sort of a wonky connection. I think I have to put my face really close to the phone. Is that any better?
Not really.
Okay, sorry.
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 Okay, thank you. Any other questions or comments before we move on to territorial rating? Okay. All right. So territorial rating, also a non-driving rating factor, but rating based on essentially where you live, or the physical location where a vehicle is primarily parked overnight. So generally insurers that engage in territorial rating assess the risk of potential claims and losses, again, based on that physical location of where a car is overnight. And territorial base rates are higher for locations with higher concentrations of risk factors. And those might include the likelihood of accidents leading to claims is higher in areas with high traffic density and accident rates. And the likelihood of criminal activity is also something that may be put into territorial base rates, leading to claims because criminal activity may lead to claims that may be higher in areas with high rates of vehicle theft. So a policyholder's premium rate can be higher or lower than the territorial base rate due to individual risk factors. Territories can be expressed in different geographic terms, zip codes or groupings of zip codes or other levels of organization. And then the more policy holders and insurers has within a territory, the more data they accumulate. And so thus larger insurers tend to use a greater number of smaller territories, whereas smaller insurers tend to use a lesser number of larger territories. And then territorial rating requirements under Maryland law, there's a few specifications. You can't base a rate wholly or partly on geographic area on its own, as opposed to underlying risk conditions. And ensure that uses territory as a factor in establishing auto rates has to submit a statement to the commissioner certifying that the territories used by the insurer have been reviewed within the previous 3 years and use of the territories is actually actuarially justified. Next slide. So no state that we could find completely bans territorial rating by auto insurers. Some states have limited how the practice can be applied. So in New Jersey, there are a number of requirements. Insurers have to recognize both qualitative similarities and differences in driving environments or mix of driving environments. They need to be comprised of towns or cities which are contiguous. They need to contain a sufficient number of exposures to result in statistically credible experience. They need to take into account the impact of the overlapping of traffic patterns on exposure to loss, result in an equitable distribution of exposures among territories throughout the state, not result in disproportionate differences, and not result in unfair interterritorial subsidization among territories that have significant differences in driving environments, population density, traffic density, mix of driver classifications, and degree of severity of loss. In Michigan, an insurer may group auto risks by territory, but they can't establish or maintain a rate or rating classification based on the postal zone in which the insured resides. Next slide. In California, there's some different standards for how territory can be used. They say that a territory has to be at least 20 square miles. And part of the rationale for that is mandating larger territories can broaden the socioeconomic characteristics of individuals within the territories. Insurers have to submit to their insurance commissioner in California a biennial report that contains the loss experience for each territory. So a good deal of information about the loss experience and separate loss data for each type of coverage written. The commissioner can make or has to make that reported data available to the public after examination in aggregate form by zip code or statewide basis. And then differentiation in rates between territories can't constitute unfair discrimination. In Connecticut, any change in territorial classifications is subject to prior approval. And a rating plan that includes territorial classifications has to assign a weight of 75% to individual territorial loss cost indication and 25% to the statewide average loss cost indication. And the idea here, I think it's a different method than the California and New Jersey descriptions, but I think trying to get at a similar result, trying to moderate the impact of territorial rating on urban areas. Next slide. Okay, any questions about territorial rating before we move on to state-sponsored programs? Okay. So my last couple of slides, just information about some unique programs in other states. So Hawaii and New Jersey are among 12 no-fault states in which a driver's policy covers bodily injury to the driver or their passengers due to an accident, regardless of who is at fault, up to the personal injury protection benefits limits. And then Hawaii has a program that provides free auto insurance to eligible low-income individuals. And they set certain eligibility requirements. They have minimum coverages that must be met. And APSO administers the program on behalf of the Hawaii Joint Underwriting Plan. Next slide. In New Jersey, there's a special automobile insurance policy that makes limited medical coverage only auto insurance policies available to drivers who are in Medicaid with hospitalization at a cost of $365 a year. And the slide goes into some of the benefits of that policy, as well as some of the eligibility requirements. APSO also administers this program on behalf of New Jersey's assigned risk plan. Next slide. And then California has a low-cost auto program that helps low-income drivers with good risk afford basic liability coverage. So the limits, I think, are lower than other policies in California. You need to meet income eligibility guidelines and own a vehicle valued at $25,000 or less. It's administered by California's Auto Assigned Risk Plan and serviced again by APSO. And it's self-funded as well as, and then a 5-cent assessment on each vehicle insured in the state funds their advertising. All right. Next, okay, so I have talked a lot. I am happy to answer any questions, but also want to give our other presenters plenty of time. So, and I think, Al, you are up next.
Perfect. Very good. Thank you. Good afternoon, everybody. Pleasure to see all of you. And all right, very good. We'll go to slide 2. Basically, I'm going to take a little bit of time, give you a brief history of how we consider affordability, what we're currently doing, and a little bit about what we're thinking about for the future. Way back in 1985, the General Assembly asked us to look at affordability when creating our rates. Originally, it started as a 15% discount in Baltimore City, where naturally the rates are somewhat higher and incomes tend to be a little bit lower. And that has evolved over the years, where for the last few years, we've been using what we call an affordability index. And the reason we use this is you don't need a lot of technology to do it. We look at every zip code in the state, and our objective is to, when considering minimum limits of liability insurance, our objective is to strive to keep those minimum limits to within 3.3% of that median income. And what that does is it's not a benefit for necessarily low-income people. It's for low-income people that happen to live in high-cost areas. So again, we look at 3.3% of the median income. If you look at our rates, we have many zip codes that are much higher than 3.3%. So we don't lower rates, we don't discount rates, we just try to keep the cap where it is. Moving to the next slide. Again, the affordability index is designed to limit increases in low-income communities that have high rates of coverage. You can see where we use the affordability index. The median income averages almost $65,000 compared to the statewide median income of a little over $91,000. I'll point out that the base rates are based on the Maryland auto loss experience. And you can see a couple of examples from earlier this year. The average per vehicle cost in 21217, I believe that's West Baltimore, is just under $3,000. If you're on the Eastern Shore, the same vehicle is a little bit more than $1,000. And you can see the average rates in Prince George's County. So that means drivers that they might be with us because of financial challenges. Their record might not be that bad, but they're going to pay $1,400 to almost $2,000 more for a Maryland auto policy in Baltimore City than other parts in the rate in the state. And as you know, the high base rates in Baltimore coupled with a high poverty rate is the reason that most of the affordability index for us is in Baltimore City. I will point out, to follow up the commissioner's comments, in addition to not looking at credit, we also do not ask about employment or education in the application process, which we believe also supports affordability. And I would ask you to bear in mind that while we do try to look at affordability, that does not mean our rates are affordable. I would invite you to go to the MIA rate guide or call your local producer and ask them to quote you with Maryland Auto and get an example of what our rates are like. Moving on, Maryland Auto is under an order from the MIA to do two things. By the end of 2027, we have to have adequate rates and we have to eliminate the affordability index. The issue is, and I don't want to speak for the MIA, they don't want us looking at affordability based on geography. We need to come up with something that is based on the individual policyholder. To become rate adequate, we'll have to raise rates in low-income communities between 20 and 40%, and we're looking forward to working with this work group to see if we can come up with a consensus on what all of us can do to look at affordability in the marketplace. Moving on, just a couple of the things that we're thinking about. So if we're going to look at affordability and do it at the individual level, the challenge that we have, we don't have the systems or the access to individual financial information. We can't get IRS records. We met with the comptroller. We can't get state tax records. And obviously, if we allowed self-certification, that would be fraught with fraud. So one of the paths that we're going down currently is the state, and this is very premature, I might add, but the state is building a platform for Maryland citizens to go to access multiple state programs. And what we're doing is we're working with them in an effort to try to leverage their platform so that we can use that platform for verification of eligibility of any affordability consideration we may create in the future. So we're not there yet. Our early conversations have been optimistic that we may be able to leverage their technology. But again, we're not there yet. So moving on, the platform, if we are able to do it, we would look at trying to create a fixed credit at the individual policyholder level for the base rate, the base liability rate for anybody that may be eligible, and all other rating factors obviously would apply. And then, moving on, obviously to be rate adequate, we can increase premiums or we can lower costs. So we are taking a multi-pronged approach to try to get closer to rate adequacy. We are looking at operational opportunities that we can identify to become more efficient. We will be going to the MIA shortly, asking for regulatory permission for a few things that we believe may make us closer to rate adequate. And as always, we will be considering any legislative requests that we could make. One of the things, just to put it out there, that we're considering is, should we consider going from a 12-month policy to a 6-month policy? Obviously, that decreases the amount of a down payment we need to collect, which we believe, is a consideration for affordability. Secondly, by having it expire at 6 months, it reminds folks that they can go back into the standard market and seek coverage. And obviously, it allows us to accelerate our opportunities to make rate adjustments for a 6-month policy. But again, those are things we're thinking about, and we'll look forward to the recommendations that come from this group. So, Madam Commissioner, thank you. Happy to answer any questions.
Thanks, Al. Looks like Delegate David Fraser Hidalgo has his hands up first.
Just a very
Delegate,
quick one. Good, Al. How are you?
Good thing.
Just a very quick one. At the very end, you mentioned a variety of reasons or a variety of potential reasons to go to a 6-month policy. But one of the ones I wanted to ask you is, and I know we've had conversations in the past, that sometimes folks sign up, get the insurance, go get their tags, and then boom, they're out. Would going to a 6-month policy help that with as far as the MVA and registration is concerned? That way they're not off as long, and all of a sudden they got to re-up, or
I might ask the MVA that. My initial instinct is no, because if somebody's not paying their premiums and they get canceled, that goes to the MVA anyway.
Right.
So yeah, I don't know whether that would improve that or not, but any experienced folks out here that have a different point of view, I'd love to hear it.
Yeah, thank you, Al.
Nancy.
Hey, Al, great presentation. I just had a few questions. This ERC, what's it called? ERC, wait a minute. Yeah. How would the offset of the premium discount be funded? Would that be built into your rates, or would that be an assessment against other, insurers? How would that operate, or you're not even considering that yet? So
yeah, we're not there yet. We first need to find the mechanism to verify eligibility before we even create eligibility or think about funding or anything like that. But obviously, to the extent that we have inadequate rates and we don't meet the surplus required in law, that in and of itself would trigger an assessment. But obviously, there's other funding mechanisms that the state could consider. Like I forget the one state that does 5 cents a vehicle. They
right, exactly.
To do that, and you could also tack money onto the registration, but the state's increased the registration the last couple of years. I don't know that that's a viable option at this point, but we're not there yet.
And so and I have another question for you, Al, but Delegate, I just wanted to let you know that Al knows I'm on another task force in Delaware, and we had a question about to the MVA because they just changed their verification program to make it more catching people that are going uninsured sooner. And we're waiting for a report to see if it's had any impact on getting people back on the road with insurance faster. So that report's supposed to be coming out soon. So we've asked for it, and Al knows about it too.
That would be
Yeah,
great.
and
That would be great. Thank you. Thank you.
yeah, yeah, Delegate, another issue is, the legislature a number of years ago required all of us as carriers to provide an insurance card to policyholders every 6 months. But my anecdotal information is law enforcement really is not asking for it to the extent that they could or should.
And this new program is supposed to be able, giving the police officer the ability to have real-time access to the records to see if they're uninsured. I guess one
Do
other
they have that now,
question-
Nancy? I'm sorry.
Go ahead.
Do they have that now? If
They're
a police officer
supposed
pulls
to, but
somebody
I'm
over,
going to
do they-
verify, because I don't know if the Maryland bought the real-time access, but I can check on that. I'm going to write that down so I don't forget.
That would be good to know, because it would be a shame if a police officer was involved in some kind of citation or interaction and asked for driver's license, registration, and proof of insurance, which is what they do, and they get an insurance card that says that it's good for 6 months, and they actually it expired, or they didn't pay their premium, and so it would be really important, I think, for that police officer to know right then and there whether that's an active policy or not, because that determines whether the car is towed and or put into a lot or something, so somebody doesn't hurt anybody. I would love to know that. I really would. Thank you.
And one other question I had, Al, is that we saw the California program. I know that California's had that lower limits program in effect. Us as APCIA, we don't take any position on a low-cost auto program, but have you considered maybe offering to those low-income people a lower limit of liability that could be considered under Maryland law, meeting the financial responsibility? I mean, that's required in California, that they don't carry the same limits as everyone else, but it is considered that they've met the financial responsibility. So I just asked that. I mean, I don't know.
We haven't, and we can certainly add it to the list. I mean, you've been doing this as long as I have. The political battles between the trial lawyers and everybody else
Yeah.
on the limits of liability, but the anecdotal information we get from the MBA is they are identifying more uninsured drivers by about 20% more than last year. Now, some of that may be because of the improved technology, but we suspect in part because of our rate increases that more people were driving around uninsured. So to the extent that we can have I don't know the numbers, to the extent we have an underinsured claim instead of an uninsured claim, I guess there's a incremental benefit to that, but I don't know that I can quantify it, but it's certainly worth a consideration.
I have a couple questions and comments as well.
Thanks, Al. I'm sorry, Marceline. I didn't mean to cut your time off.
Thanks. I mean, I want to get to my presentation, but I have a couple questions for Al too.
Sure.
Comments. First, do you know, and I don't have to have this figure off the top of your head, but going back to what you were saying about affordability and people dropping, do you know the number of folks that are in Maryland Auto right now or in the past year that are there because of either credit or because their insurance has lapsed in other places, but are otherwise good drivers? Like just what that pool is?
I don't know if I don't think we captured that information. The only thing we know is they were either canceled by their carrier or turned down by 2 others.
Okay.
So yeah, we don't have that. We don't have that information.
Okay. And then the other question I had was, well, 2 things. One, and I'll talk about low cost insurance in a minute too, but in terms of looking at presumptive eligibility, have you talked to the hospital association? Because there's been a lot of work done over the past 4 or 5 years about screening people for financial assistance and using systems already in place, like through DHS, to look at presumptive eligibility. And so if you haven't, it might be worth talking to MHA and looking at how they're implementing those things.
I don't believe we have checked with them, and that's a good idea. Thank you. We'll do that.
Absolutely. Okay.
Any other questions for Al? All right. Can roll right into Marceline. Oh, go ahead. Did I cut someone off? Thanks, Al. Thank you.
All right, thanks everybody. I hope you can hear me a little better. Marceline White, Director of Economic Action Maryland Fund. And I'm just gonna try to move quickly through the first few slides about auto affordability options and alternatives. Next slide, please. I sort of started with the 10,000 foot view about what is an affordability index. You know, just measures how likely it is an individual can afford to purchase an item in the economy. And people either compare region to region or based on personal income, and some based on its personal income. Next slide, please. So the next one is just looking at different examples in other contexts. So we all think about housing affordability and the kind of general rule, should we spend more than 30% of your income for housing? And the pluses are that's a simple measure, it's easy to use, but it does refer to different typologies, the different locations, that sort of thing, the different typologies of housing, etc. So it's maybe a little too simple. You can look at residual income, which is what's left for housing after other things are expended, after your other expenses. And that provides more variation, but it's not as easy to calculate. And the final measure there is just disposable, which is how much income goes to all the debt obligations, including housing, and what's left over. So what's disposable after you pay for everything, and how much of a percentage is housing of that, of your debt,
Hey, Marceline.
Yes.
I'm sorry to interrupt you. I'm getting a couple of pings that you're your volume is very difficult to hear. I don't know if you can use your outdoor voice.
I can try. Is this a little bit better?
I think so.
Okay, thanks. I'll use my outdoor voice.
Okay, great.
The other is on health, and it's just looking at under the ACA, a plan is considered affordable if it's less than a specified percentage of a household's income. So for 2025, that's 9%. So if it's less than 9% of the household's income, it's considered affordable. And all of that, next slide, is to sort of set some context in place for the 2017 Federal Insurance Office study, which we've talked about before. But just to remind folks, the affordability index looked at the average premium, personal auto liability premium, in comparison to median households. And they set 2% as the threshold. So it's unaffordable in zip codes where it exceeds 2%. And that was based on a national average where households spend about 1.8% of their income on auto insurance using Bureau of Labor statistics and consumer price indexes. So the findings in 2017 were that there were 10 zip codes in Baltimore City that exceeded the affordability index. It's about 12.4% of Maryland's population, and about that many, more than 300,000 people. Next slide, please. Okay. So, well, I'll just talk about Maryland autos. So let's go to the next slide. I'm just going to talk about the January 2025 study in more detail. The updated study, overall, they found the premium rates increase, loss severity increased, the loss frequency decreased. So that's a good thing. Not as many, not as much loss frequency, even though the severity is higher. The study included 3 affordability measures, 1.5%, 2%, and 3%. And the idea was to provide a more granular analysis. And the study also looked at the use of non-driving factors in a separate section. And on the non-driving factors, just as the commissioner pointed out, it looks at the fact that one of the factors is whether or not the customer will make a claim. And again, it looks at the prospective customer's personal information by including age, income, and other proxy factors. So I think it's important to just remember when we think about the study we talked about last time, which found a disparate impact, the black-white insurance gap. But state laws don't treat unfair discrimination. They don't treat facially neutral factors that may have a disparate impact as unfair discrimination if they're actuarially sound. So it's just a policy question for those folks for us to grapple with that I wanted to flag. So we can go to the next slide. The next slide, this is what it's from. The premium to income ratios in Maryland. If you look at the totals, the bottom line is that up to 16.8% of the state population experienced rates for a product that were required to purchase by law that are considered unaffordable. So if you're using the, above 3%, that's where you're at 2.1% of the state population. Going up, if you're using 2%, you're at 6.1% of the state population. And if you're looking at 1.5%, except if it exceeds it, you're looking at 16.8% of the population. So you can slice and dice it a little bit. There are more zip codes that fit into that affordability ratio. Of these, this is the number of people who may experience rates that are considered unaffordable, going from the most to the least. So just as a state, I think this isn't okay. I can talk about what it's based on, but let's go to the next slide. So for the next slide, this is just nationally from the Consumer Price Index, looking at motor vehicle insurance from 2020 to 2025. And you can see the line that's going up pretty dramatically. It's not seasonally adjusted. It's focused on the US city average, but again, based on everything we've been talking about, calls for a need for state action. So next slide, please. And this is based on a report that the Consumer Federation of America put out last week, which found that insurance CEOs' price salaries are growing while consumers are seeing premium hikes and non-renewals or increasing. So they looked at the top 10 insurance executives net in 2024. So you can see going across the insurance rate increases and the homeowner rate increases and the executive compensation increases. So while losses and costs are increasing, so is executive compensation. Some by 10 million, some by 5 million. You can go through and see. So next slide. What do we want to? This is where I just talked about state approaches, some of which we talked about in terms of affordability. New York has a subsidy of 40%, which is funded by an assessment on insurers the right in the private market. It's currently a $29.5 million assessment, and that is passed on to consumers. New York also has a very low motorist and a low premium for those for low income folks. We talked a little bit about Massachusetts. It's about a $15 per policyholder that supports the cost of covering a certain pool of drivers. The commissioner can disapprove rates and both can enter this program for 1 year to 3 years period. And insurers are subject to an assessment to cover the administrative cost to do that. California, we've already discussed that. I will say that since they've had the 5% on each policy to advertise. There are about 60,000 people in that program right now, paying more than $400. And these are good drivers. So it's when you're talking about insuring a risky pool, they're only risky because of income. These are people because of the California program that are not risky in terms of their driving record. They're risky because of these proxy factors. Bad credit or low income. And so if you want to go to the next slide, just talk about some possibilities for us to consider for discussion. I laid these out in a couple different buckets. One is increased transparency and oversight, which is to make rate filings and supporting materials available to the public. NIA does a good job with the guides, but for example, the weight of the ratings factors is no longer available for the public to see. I believe we should shift the prior approval process. And the reason being, as Nancy said, it's not necessarily affecting rates, although I haven't seen a citation for that, but it gives us a longer timeline to look at and consider. And in fact, it also harmonizes what we're doing with what we do in the healthcare insurance field. So I think it makes a lot of sense to move back to a prior approval. I've talked to colleagues in DC who felt very strongly about it and seemed to feel like it benefits them, and I'm happy to reach out to other states to use this to get more feedback to this group. So I think that's important. And we can also make sure that insurers disclose and justify the claims cost and administrative expenses. So there's just more some time in the process, which is somewhat opaque. Empower the commissioner to disapprove rates if they are unfair or inconsistent with some public policy, which is similar to what Massachusetts does. So again, just looking at this idea that something may be not good public policy, and we need to look at that from a public policy perspective as well. Next slide, please. All right. So possible legislative purpose. California has a rule for excluded expenses, and they create a formula for acceptable and excluded corporate compensation. So anything above the acceptable max can't be passed on to drivers, and certain advertising costs can't be passed on to policymakers. I know the legislature is familiar with this approach because it's similar to the Ratepayer Freedom Act that was introduced last year in Federal Economic Matters and was ruled into the leadership package. Overall, just by doing this, prohibiting certain costs being passed on to drivers, California drivers have saved millions each year. Next slide, please. All right. So certainly looking at ways to lower rates, looking forward to that conversation. We could determine the scope of what Maryland wanted to cover if you look at the 2025 FIO study. But I think starting an annual assessment process for insurers like almost every other state does helps create some funding to provide whether subsidies or support for these kinds of policies, and piloting a California or other approach in some of the areas like Baltimore City, Prince George's, that have some of the highest rates. I said California or New York, we could look at New Jersey too, but piloting something and then assessing the efficacy of it and expanding statewide, which is what California did. They started in San Francisco and eliminate the use of credit to make it consistent with homeowners insurance. We talked about the commissioner laid out other issues that how other folks use credit, and I talked about some of the reasons, which I'm happy to include. Building on the Disney study as they're moving forward, developing some sort of balancing threshold where a factor may meet actual standards but has a disproportionate cap, and determine how we want to move forward with that. So I think that is it. I know I ran through a lot very quickly. Apologize for having hard, not having some being hard, but hope this provides good fodder for conversation and delivery. Thanks.
Great. Thank you so much, Marceline. Does anyone have questions our comments for Marceline. Go ahead, Nancy. Marceline was ready for you, I think.
Just one thing that that's noticeable is that the 2% FIO study from 2017, it was 12.8% of the population. And if you look at the 2025, it has now dropped to 6.1%. So it's great to see that there's been a drop in the number that would be impacted by the 2% figure used by FIO. One other thing is that California passed Proposition 103 back in 1989. And currently they're facing some sort of auto insurance crisis. So they're undergoing some legislation to do reform for auto insurance. And I can get you some more details. I just reviewed Marceline's thing last night, so I don't have all the details to give you an idea of what they were doing to make sure that their market remained competitive. So, and thanks, Marceline. I know we work on a lot of projects together. So if we can come up a way to help Al come up with the formula to meet everything that we're talking about today, it would be great. So thanks.
Any other questions or feedback from Marceline's presentation? So maybe to go back, just wanted to get the work group's feedback on a couple of things. That was a lot of information. We have 3 charges that I think these 3 presentations cover or were intended to cover today. Again, so the first is methodology, I guess it's late on the day. Is it only Tuesday? Methodologies by which affordability can be considered in establishing private passenger auto rates consistent with rate making principles codified in the insurance article. Potential alternatives to the affordability index, and in it administrative and legislative policy options to enhance transparency surrounding and the affordability of private passenger auto insurance premiums. I guess my first, so first just would love folks' initial reactions before I start asking more pointed questions from all the information today based on the charges of the work group. And I saw the delegate come on video, so nothing.
Oh, you go ahead and ask away. I'm just trying to absorb as much as I can. You go ahead and ask away. The more you ask, the more I learn.
Okay. Any initial thoughts or reactions from this group?
I mean, I guess what I would say is that I'm grateful that we're coming together to have these conversations and that we have a number of promising approaches to discuss and deliberate on. But also I would say that we have to look at affordability because, you know, Alice talked about it, but we're seeing other costs go up. And with what's happening at the federal level with the loss of SNAP and Medicaid, I know, Commissioner, you're dealing with a lot of this already, but we're going to see people increasingly struggling on very basic needs and items. And I fear that insurance would be one of the first things to go if you suddenly lose other benefits. This is a thing they're going to drop. So looking at ways to make it affordable for people and for within their disposable income or within a reasonable threshold seems to be really important, particularly when there are a lot of companies people face breakers for not having. But we have to make it affordable for them to be able to have the state mandated product.
Yeah, thank you. Mike, go ahead.
I mean, kind of the way I look at this, you know, insurance, the amount at risk is like a balloon. We're going to push one way and it pushes it out the other side. We can push it the other way. I mean, if the rates are adequate or accurate, however you want to look at it, you know, we've priced it to be competitive. We've priced it to make a reasonable profit. Anything we do absent cleaning up the fact that we have way too many uninsured motorists just shifts the burden from one side to the other. Someone else is going to pay more money. If we create a product that lowers our limit, I think we're at 30, 60, 15. If we lower it to 10, 20, and 5, I'm going to pay more because it's more likely that I'm going to be hit by an underinsured motorist. And the things to me that would make insurance more competitive are probably way beyond our control. Obviously, the best thing we could do is better educate our citizens so they make more money. Work on the uninsured or underinsured issues. So, I don't know the exact number. Al might have a number, but there's been a huge increase in uninsured and underinsured claims that flow through our office. So I'm certainly sympathetic and empathetic to the fact that rates have risen way, way, way too much. I think you are accurate that we are seeing rates have leveled out. We have seen carriers ask for some decreases. Probably not enough to make a big difference, but at least it's a start. So I'm not, I guess you have to create a mechanism to where you can subsidize some people that it is unaffordable. And how you finance that, I can't say, but the amount of money at risk is at risk, or the risk is the risk. So either we subsidize people through like an assessment that we already have at MAIF, or some other method, but somebody's going to pay for it.
I just want to clarify for the California program quickly that you have to be a good driver. It's a skinnier policy, but to get into the program, you're not a risky driver. It's very similar to insuring the young invincibles under the health insurance program. So the idea that you're going to lose more is, they don't have as much insurance, but they're also less likely to be in an accident because they have to go into the program not having had accidents. So that's just something to clarify as we continue the discussions.
And I just sent the, Mike, you asked, it's 16.8% of the population is uninsured according to the latest statistics that we have. And I've sent over that link to Catherine, Katie Callahan, so that everyone can see it once she shares. So.
Go ahead, Delegate.
Yeah, Nancy, what'd you say, 16%?
16.8%. Delaware right now is at 17.6. So yeah.
But that's up from where it was.
It's up.
Oh,
It is up, and that's from 2023. That's not, they can only calculate it two years and prior. They can't do it right now, real time. So
last time I heard it was like 13 or 14, so it's gone up to almost 16.8, 1/6, right?
Yeah, and I don't have what it was before, but I can look it up.
Wow.
Yep.
That means a lot. All right, thank you.
So what it might just if it's 23, just to restate that again, we might not have the numbers to show the increased penalty that passed in 2024 at this point.
Yeah, we wouldn't have that impact yet.
Yeah.
And that's being discussed in other states, that maybe if you make it so that it's more expensive to be uninsured versus insured, that maybe more people will take up the insurance.
And those are 2023 numbers, right?
Right, exactly.
So by 2025, we don't actually know what the numbers are at this very moment. We can make some assumptions,
right?
Which I'm already making in my head a bunch of assumptions, but we don't have that fact in real time. Facts in real time. Okay.
And just on a aside, and I want to apologize, I just wanted to say, I have the document about what tariffs could possibly impact repair costs. Because they've been going like this each week in the news. You don't know if car parts are going to be part of the tariff, not part of the tariff, but it at least explains which tariffs are impacting car parts right now. You had asked for that at the last meeting. And Commissioner, you had asked about the cost that insurers are paying for medical when we're in a car, when we have car accident statistics versus what's being paid under PIP or under an insurance plan. I know
Yeah.
you're interested because of hospitals. We asked for it. We followed up for it last week. I was hoping to have it today, but we hope to have it by the end of the week. So my apologies for not having the documents that we were hoping to have today. But I have the delegates document about the tariffs, so I'll send that over after the meeting. So
Thank you, Nancy. And yeah, I mean, I really would like to see it. I just wonder how much value it has, because the value in the information is more what you stated, which is the incredible inability to predict what's going to happen, whether it's going to be a windshield or brake pads or a fender, and the fact that it's just up and down and up and down. That's almost the value of understanding, more than exactly which market is doing what. Just the instability is.
exactly. And some things, some tariffs are in effect. So some of them are consistent, you know, some of them on cost of steel, et cetera, are in effect. But these other ones, like with Mexico and Canada, have been yo-yoing. So this was the latest document I had last week. So
Yeah. All right. Thank you.
Maybe to follow up on that, thanks, Nancy. Is there information this group wishes we had as part of the discussion today? So we had a lot of information, but like what didn't we cover?
I think for me, I think that one of the things that that's been an ongoing discussion for the past 2 years is how to set up that affordability index for Maryland Auto. I mean, I think that, you know, at the end of the day, that's something that really is the start of the study, was to look at this. And if we can come to concentrate on that, it would really, I think, would be meaningful to try and dial down and figure out alternatives to the current formula and see if we can find some solutions.
I'll go ahead. Al, go ahead. Sorry.
No, I'm sorry. To follow up, Nancy, hold that thought. One of the things we might want to get some information is an update from the MVA on their real-time or almost real-time verification, just to see what the current reality is. And yeah, to follow up what on Nancy was saying as it relates to us directly, you know, there's the issue of eligibility. So, you know, who's going to be eligible and what are they going to be eligible for? What we're dealing with right now is how to figure out the verification of whatever the eligibility mechanism happens to be. And then finally, what's the funding look like? You know, currently we have the assessment mechanism. Do we look at anything else? And I know our folks have looked at a laundry list of things, and we'll generate a list for you of just, you know, the things that we've discussed internally.
Great. Anyone else? What information are we missing? What's missing from our discussion on these topics?
You know, Commissioner Grant, if I could just add,
Yeah.
I understand that sometimes from state to state you can't always compare, right? But and I know we kind of talked about this for a bit in our last session, but I would just be interested along that same lines of just sort of understanding what states that are doing well as far as rates go, like what are they doing? What can we emulate? Um, and I mean, I know that we're kind of talking about these various factors. Um, but and there are lots of recommendations that we could look at, but I mean, I think like anything from a legislative perspective, a lot of times, when we talk about various issues of what could we be doing to fix this, we look, we don't always have to reinvent the wheel, and and I'm not suggesting that we're reinventing a wheel here, but I'm just wondering if there's other things, what we can look at from a policy perspective, or at least as we were going into the January session, what we can be doing in the General Assembly, what to strategize to do something about these rising rates.
Yeah, thanks, Senator. Sort of on my mind, I really appreciate your comment. I also think about maybe similarly, what's our evaluation criteria that we want to establish for looking at some of these options. So yeah, we can work on putting a proposal together to react to. Okay, Mike's next, and then Nancy, and then Al.
Do you have aggregate data for, say, the top 20 personal auto insurers that shows premiums collected and claims paid out? I mean, I think it would be interesting to see an aggregate number of the 10 or 20 largest insurers and what that number looks like, if you had it.
You're
We
asking
can,
Maryland specific?
Yes, just in Maryland. I mean, I know the data exists on some level nationwide, but I'd be curious to what it looks like in Maryland back, 5, 6, 7 years, even 10 years.
are you interested in it by carrier, Mike, or by rate? Because the NAIC actually does a really comprehensive report on everything all in.
Well, I would say more in the aggregate of just the top 20 carriers or 10 carriers, whatever. I think you said, or somewhere I saw 10 carriers or 70 some odd % of the market.
Yeah, yeah.
Well, then 10 carriers.
Okay. Yeah, we'll send this around by email too, but just to bump up, there is, and Nancy may have better data, but there is a really comprehensive report. It's a few years, just like everything, it's delayed a few years. I think the next one will come out, I think, after our report is due, but it really does take an in-depth look at states across what we pay out, and all those dollar figures, so.
One thing, we talk about affordability, and I'm going to pull this thing out because I'm going to check, but it's the comparison of what's required for young drivers, because young drivers are risky drivers. And there's this calculator that looks at all the 5 different factors, and I don't have them in front of me, 5 different factors that help lower teen driving accidents, which is obviously a threat for all of us on the road. And then it looks at how many hours they require, whether or not the state has certain restrictions on passengers. I know Maryland has done some of those things, but I will pull this out and also pull out the calculator that we can see, can any of these changes be made to Maryland law for young drivers that would help lower their collision and fatality rates in the Maryland. So this is something totally new to me, and I just saw this yesterday, but I thought, well, this is perfect. This is something that could impact Maryland as well. So I'll try and get that over to you this week.
Great, great. And my team is reminding me that we're going to talk a lot about financial condition at our next meeting. So we'll really get into some of this data next meeting, but definitely send it around if you have anything to share. Okay. Al, you're next.
Yeah, thank you. Just a quick follow-up to Senator Giles' question/comment about the legislative session. Obviously, there's no silver bullets with any of this stuff, but I may have mentioned this last week. I think the legislature would be well served to look at some of the predatory towing and storage practices going on in Maryland. Also in Maryland, particularly in urban areas, it is fraught with insurance fraud. And additionally, I assume all carriers have, I know we have seen a significant increase in severity claims due to a significant increase in jury awards in Maryland. And a significant increase in jury awards drives the amount that you have to offer to avoid getting into litigation to begin with. So, those are all incremental factors, I think, that's driving up the cost. Thank you.
And I can only echo what Al is saying. We were able to come up with some, we had a work group between commercial towers for police initiated tows on I-95 and other major routes, but that doesn't apply to local towing rates. And we are seeing astronomical storage fees for when they're not on police initiated tows. For example, they're charging X amount for covering a vehicle because it's an EV vehicle with a blanket, which is this outrageous charge that has nothing to do with the cost of the blanket to go over the vehicle. We've talked about this for 2 years with a small group, and we would love to be able to either talk about comparing towing rates and storage rates and et cetera, excessive charges across the state. It's great that we can do this for the large truckers on the big highways, but it also impacts all of us on when we're just traveling on regular routes when we're towed during an accident. So that would be a great discussion as well.
I would just add, I think I sent it around last time, but there is a work group looking at towing issues right now in the General Assembly. Pierce Smith is supposed to be leading that effort, and towing rates are set by county, because I work a lot in Baltimore City with Councilmember Dorsey on towing issues in the city. So I agree that predatory towing is a real issue. I do think, given everything that is happening at the federal level and the affordability crisis we have, that looking at things that can bring down the cost of auto insurance and other kinds of basic goods, obviously, but for the purposes of this conversation, looking at ways people can actually feel a reduction in their pockets and would be really helpful, especially for low income and working families. And so I hope we can come to some proposals and the General Assembly could consider for next session.
And Marceline, we did look at the letter, and that's talking about being towed off of private lots.
Yeah.
Which, obviously that's not something that's part of an auto insurance claim, but if we could move that over to look at regular towing for after an accident on regular streets, that would be wonderful. We would love to do. And thank you for bringing that to our attention.
Any other thoughts on anything we discussed today before we see if there's any public comment? I will say that I think, yeah, these are meaty topics. It's gonna take a little to get there. I do think we're gonna put together maybe some evaluation factors, and I think, as other folks have suggested, make sure we have a clear picture of some of the financial data as well. Aaron, did you want to pipe in?
I just wanted to mention there was a discussion before about increased scrutiny of auto rates. We have kept a track of since the beginning of 2025. We've done additional scrutiny on rate increases for really across the board on all lines of business. And up till now, we've recorded about 5.4 million in savings to Maryland consumers based on just reviewing the filings as they've come in and pushing them down a little bit as to where we feel they're justified. And out of that, a little bit less than 3.2 million savings for auto customers in personal auto.
That's great.
We're so grateful to our actuarial team. Thank you, Erin. Thank you, Erin. And that's within our current standard. So.
I just wanted to say, Erin, I had a compliment. One of my carriers had worked with you on a rate filing that had been sitting for a long period of time, and they really appreciated working with them to address your concerns. So just wanted to say they were glad to have Erin on staff. Now that we have him, that we can use him more often. So
Us too. Us too. All right. Well, yeah. We'll make sure that we'll include some communication on evaluation factors, and we'll keep the discussion going. So any last questions before we see if any of our attendees want to comment? Okay. So I think Craig is if you're on the attendee side and you had a question or a comment, you can raise your hand, and then Craig from our team will move you over. Is that how it works, Craig?
Yes,
Or
it is.
allow you to talk? Okay.
Yep.
Great. Any folks in the public that want to say anything, please raise your hand. Okay, go ahead. I think, Marta,
Sorry,
you
can you hear
should
us?
be able to. Oh, there you go.
Am I unmuted?
Yes, we can hear you.
Great.
Thank
Okay,
you.
I'm sorry, my video's off. Just briefly, Marta Harding, I represent State Farm. I want to echo something that Al just said. He talked about jury verdicts in particular. I think that is part of a broader context that I do think it would be helpful for the work group to have information on sort of an array of things that are some of the underlying loss cost drivers in the state. Jury verdicts, is sort of the compilation of a lot of things underneath it, and just sort of an understanding of the things that, while no single one of them is the reason alone that our rates are where they are, they certainly are part of a larger whole that drive costs overall. So we talked a little bit last time about Maryland's threshold for demanding a jury trial. There are a variety of other sort of civil justice rules that I think our claims litigation counsel could point to that have an impact on their ability to defend claims, settlement process, et cetera. So I think there could be some value in just gathering some additional information. And Bob Enton, I think last time mentioned the cap on non-economic damages. That's looming, and maintaining a reasonable cap there, which can drive costs as well. So I just wanted to echo kind of what Al said and just broaden it a little bit. I think that kind of information might be useful for the work group.
Great, thanks, Marta. Any questions for Marta? Thank you. Anyone else in the audience that, oh, go ahead, Nancy.
I forgot when Marceline was doing her presentation, she mentioned medical debt for credit history. And generally, because it hasn't been used a lot, it's banned in the NCOIL model. But just last year, and I know Marceline, you were really involved in it, we passed House Bill 1020 that ban medical debt being reported to the Consumer Protection Agency. So even though it's not stated in the insurance law, it is stated elsewhere that medical debt can't be used by credit reporting agencies. So just wanted to make that one clarification.
Thanks, Nancy. And yeah, that should stand despite the new guidance coming down from the CFPB. The way we passed it in Maryland is pretty tight.
Great.
Great. Any other members of the public want to comment? You can raise your hand. We'll move you over. All right, well, we're getting closer to 5 o'clock. I'm sure folks would love a few minutes back. I really thank you all for your engagement and work on this. We'll be following up with some materials, and yes, at our next meeting, we'll really be diving into some of this financial information and financial conditions. So look forward to the continued discussion. And Nancy, go ahead. Did you have something? Oh, you're good. All right. Well, thank you, everyone. Have a great evening. Thank you so
See you later.
much.
Yeah, thank you.